If you put $500 a month into a simple index fund and just left it alone for 30 years, history says you would likely end up with somewhere between 600,000 and over $1 million. Not from picking the right stock, not from timing the market, not from some secret trading strategy, just from doing the same boring thing on the same boring schedule for 3 decades. That number surprises most people because $500 a month doesn't feel like much. It's a car payment, a few nights out. But money that grows for 30 years stops behaving like money you're used to. Before we go further, a quick note. This video is for general education, not personalized financial advice. It's meant to show you how the math of investing actually works, not to tell you what to do with your own money. Talk to a licensed financial advisor about your specific situation. Let's start with the plain arithmetic, because it's more interesting than any hype video makes it sound. If you invest $500 every month for 30 years, you personally put in $180,000. That's it. That's the part that came out of your paycheck. Everything above that number came from growth, from the market doing what markets have historically done over long stretches of time. Using a conservative long-run return of 7% a year, which is roughly what a diversified stock index has returned after inflation over many decades, that $180,000 in contributions grows into about $613,000 after 30 years. At a more optimistic 8%, you're looking at around $750,000. At the historical nominal average for the S&P 500, closer to 10% before adjusting for inflation, the number crosses $1,100,000. The gap between what you contributed and what you end up with, that gap is the entire point of investing early and staying invested. Here's the part that trips people up. The growth isn't smooth, and it isn't front-loaded. In the first 10 years, putting in $500 a month at 7% growth, your account is worth about $87,000. You contributed $60,000 of that yourself. It barely feels like investing is doing anything special. In the next 10 years, the account roughly triples to around $262,000, even though you only added another $60,000 in contributions. And in the final 10 years, it more than doubles again on the back of the exact same monthly contribution you started with. The money isn't working harder in year 30 than it did in year 1. It's working on a bigger base, and that base compounds. This is why people call compounding slow, then sudden. For years, your own contributions are doing most of the visible work, and the growth line barely lifts off the ground. Then at some point, the balance is big enough that the market's normal ups and downs are worth more in a single good year than an entire year of your contributions. That's not a trick. It's just what percentage growth does once the base gets large enough. It helps to compare this against the alternative most people default to, leaving that same $500 a month sitting in a regular savings account. At a 2% interest rate, which is fairly typical for a standard savings account, that same 30 years of contributions grows to about $247,000. That's still real money, and savings accounts have their place for short-term cash you can't afford to risk. But compared to the roughly $613,000 from the index fund example, the difference is about $366,000. And the only thing that changed was where the money sat. Same person, same monthly habit, same 30 years. The account you choose does a huge amount of the work. It's also worth asking what that final number is actually worth once you get there, because a dollar in 30 years doesn't buy what a dollar buys today. If inflation averages 3% a year over those 3 decades, that $613,000 balance would have the purchasing power of roughly $253,000 in today's terms. That's still a meaningful sum and still far ahead of leaving the same contributions in cash, but it's an important, honest adjustment. Anyone showing you a big future number without mentioning inflation is only telling you half the story. There's one more variable worth mentioning: raises. Nobody's income stays perfectly flat for 30 years, and if you increase your monthly contribution by just 3% a year, roughly in line with typical raises or cost of living adjustments, that same starting point of $500 a month grows into around $834,000 by year 30, still at that same 7% return. You never had to make a dramatic lifestyle change. You just let your contribution creep up alongside your paycheck instead of letting your spending absorb all of it. Age matters here too. Someone who starts this exact habit at 25 instead of 35 isn't just getting 5 extra years. Because of how backloaded compounding is, 40 years of $500 a month at 7% grows to around $1,320,000, more than double the 30-year number, even though total contributions only increase by a third. The earliest years of investing are the cheapest years you'll ever have to buy that kind of growth. Now, timing matters more than most people expect, and this is where a lot of financial regret actually comes from. If you delay starting by 10 years, investing $500 a month for 20 years instead of 30, at that same 7% return, you end up with roughly $262,000 instead of $613,000. That's a difference of about $350,000, and you only skipped 10 years. You didn't invest less money overall by much in percentage terms, but you lost a decade of compounding at the end, which is exactly the decade doing the most work. This is the single biggest argument for starting now instead of waiting for the right time or a bigger paycheck. Let's clear up a few myths because this space is full of them. Myth number one, you need a lot of money to start. Reality, $500 a month is a useful example because it's a round, relatable number, but the math works the same way at $50 a month or $5,000. The mechanism, consistent contributions plus time in the market, doesn't require a minimum bank balance to function. Myth number two, you need to pick winning stocks to get rich this way. Reality, the numbers in this video assume a broad index fund, which simply tracks hundreds of companies at once. You're not betting on any single business surviving or thriving. You're betting on the economy as a whole continuing to grow over decades, which has a very different risk profile than picking individual stocks. Myth number three, market crashes ruin this strategy. Reality, crashes are part of the average. The 7 and 10% figures used earlier already include recessions, crashes, and multi-year downturns baked into the historical data. What actually ruins long-term investing isn't a crash. It's panic selling during one, which locks in the loss and removes you from the recovery that typically follows. Someone who kept contributing through a downturn actually buys more shares while prices are lower, which can help the long-run average, not hurt it. Myth number four, this only works if the market keeps performing like it has in the past. This one is worth taking seriously because it's the honest caveat. Past performance doesn't guarantee future results. 7, 8, and 10% are historical averages, not promises. Some future decades could return less. Fees, taxes, and inflation also eat into real returns, and none of those were factored out of these examples. This is exactly why the goal of this video is to explain the mechanics, not to promise an outcome. So what's the actual takeaway if you're the person putting money in every month, watching the balance barely move for a while? First, understand that the early years are supposed to feel unimpressive. That's not a sign it isn't working. It's a sign the base is still small. Second, the 10 years you skip at the beginning cost you more than the 10 years you might skip at the end because compounding is backloaded. Third, consistency beats timing. Nobody in these examples tried to buy low and sell high. They just kept contributing the same amount, month after month, regardless of what the market was doing. To recap the numbers, $500 a month for 30 years means you contribute $180,000 out of pocket. At a conservative 7% return, that becomes roughly $613,000. At the higher end of historical stock market averages, it can cross $1 million. Most of that growth shows up in the last 10 years, which is exactly why waiting to start is the most expensive decision in this entire equation. If this kind of plain numbers breakdown is useful to you, subscribe, because next week we're digging into a related and slightly uncomfortable question. Why the middle class tends to stay the middle class even when income goes up, and which specific financial habits quietly keep people stuck regardless of how much they earn. It connects directly to everything in this video, just from the other side of the equation. This video is for general education only and is not financial advice.